All right, welcome back. This is a video based on Module 2, Lesson 3A, and it's on intermediate term lows and highs. But first, I want to go over an intermediate term low and what it is and show you a market scenario and how you would be using it. So an intermediate term low is a low with short-term lows on either side of it. Let me go over that again. An intermediate term low is a low with short-term lows on either side of it. Am I saying that right? Short-term lows on either side of it. All right. A long-term low is a low with two intermediate term lows on either side of it. A long-term low is a low with two intermediate term lows on either side of it. All right. So I'm going to be showing you a market scenario of what that looks like. We're narrowing down from a weekly chart, euro dollar weekly chart. So right here, I can spot an order block right there. And spot another block right there. So another block, weekly order block. I'm just going to label that weekly block right there. So I will be taking a look at price action in this area, that area right there. I'll be taking a look at what price did there. So let's drop down to a lower time frame, daily time frame, right there. We can see how price reacted from that order block moving to the upside. So we have a strong bullish run to the upside, just searching for liquidity on the 4-hour chart. You can see price respecting fair value gaps right there, taking liquidity, grabbing more liquidity, making lows, equal lows right there, but just a good, very good bullish one controlled by price algorithm. Now let's drop down to the 1-hour. Why we're here. This is why we're here. We just want to show you intermediate term lows, and I typically look for these on the 1-hour. I don't spend a lot of time on the 1-hour. I look for these lows or highs, intermediate term lows or highs, SMT diversion, and I'm out of here. So what are intermediate term lows? Where there are short lows that have short-term lows on either side of them, and lows that cover up fair value gaps. Lows that cover up fair value gaps. So right away, from that definition, you can just see that's right there. It's an intermediate term low. So I'm just going to label that intermediate term low right there. Intermediate term low. We can spot another one here, right there. Lows on either side of it. Actually, there's a lot of them. This is a little bit lower than this, so they are all there, scattered all. But say you were here, was your live market. You were right here. You will be going with the most recent one. So if you were here, this bullish candle, this is your present price. You can't go with this one. You have to go with this one, right there. And this is where you expect price not to trade below, because it's an intermediate term low. Because this was the low of this candle, 619. This is 615. Yeah, so this is even lower than this, so you can't use this one. So I'm guessing this is the one you'd be using. Price shouldn't trade below this. And then this is another one right here. So price shouldn't be trading below this on a strong bullish run. Price shouldn't be trading below here. If price traded below here, then you'd have to, it should give you an idea that something is happening with your bullish run. Your bullish run is being compromised. Price is changing gears. price is shifting. So that's the idea. That's what it should give you. And that's the primary use of intermediate term lows. Price should not be trading below it if your bullish run is correct. So what is a long-term low? A long-term low is a low with two intermediate term lows on either side of it. So right here, I can spot a long-term low. Long-term low right there. Can we spot intermediate term low here? This is not one. It doesn't have short-term lows on either side of it. This is not one. It has a short-term low, but this is lower than it. We have one right there. Boom. Short-term low on either side of it. So that is a intermediate term low. But remember, we're looking at price from a hindsight, and I'm just saying, assuming this candle right here, this was the start of your day. Let's use this line. This is a day separate right there. That's what that line is, 24 hours. So 12 a.m., the start of your day. What intermediate term low would you be working with? What's the most recent one would you be working on? A bullish on a bullish one right there. So price shouldn't be trading below that. If it could sweep this lows, sweep that low, which it did on this day before a bullish run. Anyway, so that's what an intermediate term low is, and that is what a long-term low is. And that is the market's situation in which you could apply this. And if I could just mark this out, this one right here, you can see that for a while on that bullish run, price never traded below it. So that's basically what an intermediate term low is. I'll be going over what an intermediate term high is, which is basically the opposite of this, but I'll be showing you examples right now. Okay, let's jump right into the next example. And here we are talking about intermediate term highs, long-term highs, short-term highs, but more of a focus on intermediate term high. I've already labeled everything right here. Long-term high from the previous definitions I gave you. This is the 1 hour time frame. Long-term highs, you can find intermediate term highs on either side of it. And we find intermediate term highs. See a high here. This is not an intermediate term high. This is not one. This is one with both short-term highs on either side of it. So just right in front of you, so you get an example. I'm going to label it intermediate term high, short-term high right there, clone, short-term high right here. So I have an intermediate term high here. I have an intermediate term high here. So this is a long-term high. And what happens with intermediate term high? What do they help us with? This is a bearish trend. If you go up to higher time frames, you see that we're on a bearish trend. And intermediate term high are not supposed to be traded above. They just help you solidify your bias. This is the 4-hour chart. I just moved up to show you. Right back down to the 1 hour. Before we broke out of that intermediate term high that I marked, tells you we are no longer bearish. We would now be looking for buy scenarios, buy market structures when you saw a breakout, a trade above that intermediate term high. But it's like a short-term confluence that helps you navigate your way around price and market structure. So how to identify long-term highs, short-term highs, and intermediate term highs. Ignore this. This is manipulation from news. So this is your intermediate term high. It never got traded above until we broke out of this bearish run right there. So when I jump on my 1 hour chart, this is what I look for. This sometimes I don't label it out. I just sort of eyeball it on the day that I am on. I look back just a little bit to see, okay, I am in a bearish market This high is where price shouldn't be trading above because it's an intermediate term high. Remember, intermediate term high is also a high that covers a fair value gap, a high that was formed from covering a fair value gap. And by that definition, I think this is an intermediate term high actually. Intermediate term high actually. This is an intermediate term high. But this wouldn't even stand because it was traded above there. So yeah, short-term high. Short-term high. Anyway, so that is the primary use of an intermediate term high. That is how you use it. That is how it comes into play when you are looking at market structure and sort of building your narrative before you move down into lower time frames to take your setup. All right, so that's it for this lesson 3A.